How are you liking the market today?
It's kind of boring.
Yeah, it is. It's after,
It's kind of
especially after
boring.
yesterday's drama.
I know. We were on like wait, you were here yesterday. We were
Yeah,
watching it.
yeah.
Yeah, we were watching it. Yeah. Yeah, nothing happening today. Not really anything big on the news front either. We'll be talking about that too and getting into it. But like, I don't know. I mean, just going over it briefly, but basically what the jobless claims, everything's just kind of humming along. Not much to say there.
Yeah, yeah. And jobless claims. I don't think there's been anything interesting going on in that for years now.
No, no. People yeah, yeah, we've been talking about that, you and Jack. Just who cares, man? Who
Right.
cares about all these events, right?
Yeah.
It is interesting, like what what Jack was talking about earlier this week. It's like 2.4, 2.7%. Like uh how are we that, focused, and how can you actually determine like what actually is inflation, right? It's kind of hard to say. Like I know they have their basket of goods. It's like sort of a scientific method, but still it's kind of just
Yeah.
throwing a number out
They're
there.
just guessing.
Yeah.
Yeah.
Oh yeah. Hey, what's up, man?
How you doing?
I'm good. I'm good. We got some really cool stuff today, folks. So we're gonna hit both Kane's wheelhouse and Jack's wheelhouse really good, and hopefully my wheelhouse too towards the end here. But Kane's gonna be talking about some volatility hedging with the portfolio, right? That this seems like a really advanced thing, and it is more advanced, but people can do it too. We're also gonna be looking at Jack after that great discussion we had with Jeffrey on Tuesday, I believe. I went ahead and made a premium scanner. I thought it could be cool, so I picked up some stocks that I want to run by you on the premium scanner.
To do the strategy we were talking about, the wheel?
Yeah, to do that strategy, or just to sell spreads, whatnot. Just something that you can anything that you can use to collect premium on some of these tickers. But I think I found some that are pretty juicy. So
Good.
I'm gonna get into to that. Before we do though, we're not financial advisors. The content presented today is our own personal opinions and is meant to be education. In order to make the best financial decisions, you need to do the ones that suit your own needs, conduct your own research, seek the advice of a licensed financial advisor if necessary. Though all investments involve some form of risk, there is no guarantee you will be successful in making, saving, or investing money, nor is there any guarantee you won't experience any loss when investing. So please do always remember just to make smart decisions and, of course, do your own research. So yeah, we're talking about this. Jobless claims came in lower, but whatever. Retail sales were high. That's pretty cool. I mean, hey, American consumer is gonna spend. I'm sure there's some intricacies to it in terms of what they're spending on, but overall, the downfall of the American economy is going to have to be put on pause for all those perma bears out there. Those, as the Trump administration said, those panic hands. But what is interesting is I don't know, home builders. If you look at like a stock like Lennar, they are just they're they're down bad. Um, uh, they're slashing prices, and I guess this means a supply glut. People at these interest rates, they just can't offload them from all these subdevelopments. Interesting that I went down to visit my buddy in Wilmington, North Carolina. I go down every year, and I swear every year is like he lives on this basically, it's a sort of like a big road, and I mean there was just probably a dozen last year of these big subdivisions being built, and I was like, wow, that is a lot of people moving to the outskirts of Wilmington, North Carolina, and it seems like that might have been a canary in the coal mine for at least these home building stocks. Um, but yeah, I mean, before we get into this, so I got a high premium scan we could talk about with you, Jack, and Kane too. But anything you guys are watching today in terms of the news, in terms of the situation, any
Not any economic situation, but You know, I've been big on Hood, Robin Hood, and
Yeah, yeah,
cannot
yeah.
believe how that thing's ripping. I
Man,
got a little first piece of around 55, 56, 57 bucks, and you know, it got away from me. And I think it's going a lot higher. So I've been digging that.
look at that. It just
Yeah.
keeps on going. I mean, these are some big moves too. Up, up, up.
So once you find something that's trending like this, you got so many angles you could take. You could straight up go long the stock. You could go long the stock, sell calls way higher. The beta on this thing is beautiful. So whenever you got a stock with a beta over 1 that's trending like this, you got all kind of money coming at you. Buy the stock straight up, buy calls, debit spread. You could do credit spreads. You could do naked puts on this because it's just not too expensive right now.
Hmm.
So I'm on this thing like stink on a monkey.
Yeah, I
And
wonder what the premium is if you wanted to do a naked like 85. Like I'd probably it'd be cool maybe
I
85.
do it 95 or a
Yeah. That's
96.
okay. Yeah, yeah. So you really want to own this thing, whatever it is, right? I
I
mean,
don't
it's
think it's going to come back to 96, but I'd be buying it hand over fist if it did.
yeah. Good morning, Maggie. Good to see you. Wow. Let's look
This
at
thing
what
is
the
right. Yeah, the naked put. What can you get for a 96, 97 put that expires sometime at the end of August?
yeah. Let me look it up right over here. Hood.
Hood's got some exciting news coming up. Really amazing news. So does Coinbase, but Coinbase is a little too high.
Look at that premium. So I mean, even at 90, which is right, it's you know
The 95.
95. Yeah, and if and for folks who yeah, I mean that's juicy as heck.
Yeah.
It's only in a yeah, and but even if you do have a smaller account, you can go down to you can still get some good stuff at 90 or even 85 really.
The thing about this here, folks, is that if you sold a 95 naked put, you're going to get paid $385 just to make a promise. That's why I like that. Getting paid to make a promise. That's it, right? And
Hmm.
if it doesn't come down to 95, you don't get the stock, but you keep the 385 bucks. That's not a
Yeah.
bad sandwich. If it does go to 95 and you get it assigned to you, your real cost is 95 minus 385. So again, you could turn around and sell it for the price you had it assigned to you, and you still make 385 bucks, right?
Yep.
Now, if you do get it assigned to you at 95, you could turn around and start selling calls. I mean, the cash flow,
And then you could get these,
it's ridiculous.
for the
You know, you're
cause.
taking an asset.
400. So.
Yeah, you get another 400 bucks. You take an
Yeah.
asset and you cash flow that asset until the cows come home. That's
Yeah.
how to do it. So I'm doing the same thing with IBIT. Now you got to be a Bitcoin believer, which I'm really not a believer in Bitcoin, but I'm trading it anyway. Uh,
Well, this
bet,
crypto regulation bill looks like it's going to go through the House. So
yeah, man, this is going higher too. But Hood's already really ripped. But IBIT, it's a spot Bitcoin ETF that's pretty nice. It's not leveraged or anything like that. It's just spot. So
yeah,
Bitcoin goes up, this goes up, but it's 67 bucks. You know, that's very affordable. Again, naked puts on this thing are great. Covered calls, which I've been doing like mad on this thing. Uh, they're just it's been great. Both sides, naked put and covered call. I'm long 1,700 shares in full disclosure. I'm also long hood in full disclosure. So that's what
no,
I'm finding these not too outrageously expensive stocks, and which is what other people want. And you know, they want me to show them some ideas, and these are like my two best right now.
IBIT and Hood, folks. We'll write that in the chat. So
Those are
what are the risks of selling naked put? I mean, obviously you have to buy it, right?
yeah.
But
Well,
then you
the other risk is that you buy it and it keeps going down,
keeps going down.
which
Exactly.
is
Yeah.
why for me the naked put has to be predicated on a stock that's in an uptrend. Otherwise, it ain't happening for me. The trend is everything. Once you got that, you could do so much. Without it, you're doomed.
Yeah. And if you look at hoods, if you look at hood over here, you look at that uptrend. I mean, this is a strong uptrend. I mean, we're above the this is the 9 and the 50, and then the sorry, it's the 9, the 50, and the 20, 9, 20, and 50. But I mean, you can add the 100 in there, you're even farther above the 100. But I mean, you have a long ways. I mean, this is a strong trend right here.
Yeah, it's good
We're not the moving averages aren't compressed. They're pretty wide. This is looking good.
What's that say? Goldman Sachs and Cantor raised their price target.
Okay, let me move all my video here. Yeah, so let's see. Ah, man, I hate when it does that. It doesn't show you. It has the news, but then it doesn't show you any. But they raised their price target for Robinhood markets. Yeah,
Schwab has got to be just going crazy when they see what these guys are doing. Their hood is so innovative, right? Just you're going to be able to bet all kind of sports markets, all kind of stuff here shortly. And these more traditional brokers, they got to just be flipping out because hood is marching right through. The younger traders and investors, they're gravitating to the hood platform more so than they are the Schwab platform. So
yeah. I mean, Gen Z, the earlier millennials, they're all using hood. Who
they're all
uses
using
hood in the chat
hood.
to trade?
Yeah.
Anybody watching this uses hood instead of Schwab or Fidelity or anything? You got any hood traders?
I don't use hood. And when hood came out, I was the biggest hood bear, but since then, these guys have really cleaned up their act and got this thing on the right track.
Yeah, they had a little bit of you know, they were doing some shenanigans back in 2020, 2021. But
Nothing, that's the thing though. They got busted publicly for selling order flow, but
yeah,
Schwab sells order flow. It's just
yeah,
not, it's just not as, I don't know. They wanted to kind of gang up on these guys in the beginning and talk about all the bad things they were doing at Robinhood, but all the brokers do the same thing. Schwab sells order flow as well. And it's no big deal selling order flow. It's not like you really miss out on anything. So Scott says hood's the best, cheapest and easiest. Yeah, that's what they want. They want to give you more things to bet on, sports markets, predictive markets. You could bet who the next president's going to be, all that kind of crazy stuff. Rose says
yeah,
it's very intuitive. That's exactly why they made it like that. But I don't use hood. Just telling you, I do trade through Schwab, as ironic as that sounds. But I'm a big believer in where this thing is going and how they're going to innovate. Right? That's the key thing. How are you going to innovate to keep newer investors happier with more bells and whistles and easy access and intuitive platform? Right. So that's the hood story. Old
yeah.
fart, get with it.
I use a. I'm a little younger than Jack. I use Schwab actually too. What do you use, Kane?
I use, yeah, same thing. Thinkorswim, Tasty.
Yeah,
I'm all sorts of platforms, but not on Hood.
I'm not on it
yeah.
either. I love Tasty and I love Thinkorswim. Really, really like those. But aside from that, this is just about the stock. I really don't like to get into the fundamentals too much because when I start getting fundamentals, I start talking myself out of the stock, out of the trade, right? I don't want to know. I used to trade and I didn't even want to know what the company did because I'd immediately talk myself out of it, right? Beyond Meat, that kind of stuff. Remember that? Yeah, it's crazy. Like
Yeah.
I don't want to know about it, but now I kind of want to know a little bit about it, and keeping in. Another thing I got to tell you is staying in the trade longer has really helped me out, where I normally would be 2 to 10 days in a trade. Now, if I have a runaway winner like I do in Hood, if I buy it at 55, I'm not going to sell it at 60 like I used to, and that's
Mhm.
really paying off is let these suckers that are run, let them run because you need that runaway winner every now and then to make up for the inevitable losses you're going to rack up, trying to take pot shots. So when I get that runaway winner like this, that really eats up and takes care of a lot of losses and still adds a lot of green to the bottom line.
Yeah, I mean, if letting those winners run, you know, if you're tighter on your taking profits, you have even if you're winning, right? The losses can actually make your portfolio
Yeah.
balance
And
worse.
the other thing is, when I look back, I never pick tops and I never pick bottoms, and I don't believe anybody can do that. But I do leave a lot of money on the table, and sometimes that bothers me a little bit. Normally, I leave money on the table, but like in the case of Rocket Lab, Lance and I were trading that together like $9 or $10, right? Then I get out at like 14, think I'm a genius, and now I look back on what's Rocket Lab, like 30 some bucks, right? So
Yeah.
you can be smart and stupid at the same time. But best part about trading is taking a profit. So I tend not to try to look back on the rocket labs that triple or quadruple from where I got out.
Yeah, yeah. It's just follow the trend. I mean, I said KISS, right? The principle, keep it simple, stupid, right? It's just like don't overthink these. You can do all the fundamental analysis. You can start diving into the you know the financial statements and whatnot. But like, yeah, I mean, too much data points, right? We have so many data points. And this is something I always wonder, like what Jack, this right before the internet, before when people just literally had to like read the Wall Street Journal to get news. It had such a different environment now. They're just people didn't have as many data points. Like you wouldn't, we follow these market events, the PPI prints, CPI prints. We follow the Fed statements, the FOMC meetings. It's almost like a sports season, right? With the markets now. Which I've never traded outside of that environment. So I don't know what it was like back in the day before so much information was at your fingertips.
A
Which is
little,
good, but also bad.
little
I
bit
think
more
there's
difficult trying to find trades back in the day, but now sometimes you have information overload. I mean, too many bells and whistles on this stuff. You can't decide if you should, if you're on foot or on horseback. So there is almost too much now, and some of these platforms you see, it's just too much information. But
yeah.
the new technology has made it a lot easier, especially for the stuff Kane does. More technical stuff.
Yeah, so well, I think there's a big difference between data and intelligence, right? And that's
Right.
what people don't really realize. We entered into the data era, but we need to shift into intelligence era. We need to do something with that data. So, or we need to find some sort of meaning or some sort of edge utilizing that data. So just getting a lot of data, it can just be a lot of noise. That's why like people are like, well, we don't know what tariffs are going to be. We don't know what the Fed's going to do. Yeah, guess what? We didn't know that 20 years ago either, but we traded anyways. So, and I was telling people yesterday is like, if I was still at my desk at PIMCO or anywhere else, and someone asked me, Kane, what do you think this is going to do? And I answered, I don't know. I probably would have been replaced the very next day. Right? You're supposed, as a manager, you're supposed to have an opinion. It's okay if you're wrong, but you have to be able to defend that opinion, trade off of that opinion, and then hedge yourself if you happen to be wrong. So you still want to, uncertainty is the name of it's the only reason why you can make money in the markets is because they are uncertain. If everyone knew what the price was going to be, then the price would just pin right there and never move. So
Right.
we got to be comfortable with the uncertainty.
Right. And we're gonna talk about later. Don't worry, RMW. Kane's gonna be getting into how to hedge positions and using volatility. There was a couple more tickers. My scanner did pick up on premium. Unity Software is an interesting one. And what's really cool. So Unity is a software platform for game development. Um, and it's basically what's really been cool in the last like 5 years is the democratization of games. Unity allows solo developers just to come out with video games for really cheap with really good graphics. And the video game market is bigger than Hollywood. I mean, it's many times at this point bigger than Hollywood, bigger than movies. People love their video games. I know, Jack, you said your grandkids play Fortnite. Um, I think that's built on Unity.
Yeah, it plays a
And
lot of Fortnite.
Yeah, and the premiums are pretty juicy on Unity too. I mean, if we're going out to uh August 15th, I'm bullish on Unity. I think it's going to go, I mean, I think we're not even at all-time highs. We've had a pretty big significant little jump up here, but you go down to where the last sort of resistance support zones were at, $27. You can get or maybe even a little early, maybe like 30 right here. You can still get some pretty juicy premiums. $100. You go be a little more aggressive. You can get into the high hundreds, $200. But yeah, it's I think Unity's here to stay. Video games are just going to become more and more, especially with AI combined with Unity, which they're doing some really cool stuff with. I mean, these people are coding games in a week that would have taken a lot long. I mean, this entire it's the same with like software at Amazon. Entire dev teams on the video game side, 100, 200 people can be done with like a team of 10 people. So, just not to nerd out, but there's this game called Atlas Obscura that just came out that's like the best, supposedly, I haven't played it, best game of the year. Former EA, Electronic Arts devs left, one of those big development groups. It was like 20 of them made the best game of the year using Unity. So look, if you don't play video games, don't worry about any of that. I'm just saying that I really like Unity. And then the other, let me look at the other ticker that was on the, oh yeah. So Unity, SMR is another one. This is the small modular reactors. Again, we've talked about these themes, right? Nuclear stocks, drone stocks, SMR is a good one. And if you go down here, oh, I'm not sharing my screen, am I? But if you SMR, NuScale Power, you go, let's see what the premiums are for that one, right around that last before this, in that consolidation band. I mean, you can get $200 at $38 at a $38 strike, which is right around here, which I think nuclear's, I mean, we're getting news every week about new nuclear projects being launched by the administration and by the big tech giants like Google and Amazon and Microsoft. So again, pretty juicy premium. And then the last one on the watch list for Rhonda was Toast, which is one of those. If you've been to a coffee shop recently, you probably might have used Toast. But again, what's cool about Toast is those high premiums. We've broken above a little resistance line from this trading in this band here. You go down to like 40, $43, and you can get, let's just look at Toast. You can get, again, not as juicy as IBIT, but you can still get, or Hood, but you can still get, in the 200s, just about $43 a month out. So pretty cool stuff. And again, you can always do, like, I know Jack, you like to go a month out. We were talking with Jeffrey earlier this week. He likes to go, just does the weeklies. He's more aggressive. It's not perfect on the weeklies, but hey, you up the contracts, you can still get some, instead of just doing one, you could do multiples. You can still get some nice premium out of those. And you get, so just like, yeah, I think, to what we were talking about with Jack, that whether it's naked puts, whether it's, doing the wheel strategy, just finding those high premium stocks can be a good income generator for folks. So let me see. Well, let's get into, so I know Kane, we got your segment today, right? So Kane was talking about if you want to make money, you got to have a thesis. And then you gotta, to actually make money, you do have to spend money. You do have to actually trade in the markets to make money. You gotta pony up. But that's not to say that you just, go on a YOLO bet, right? There's smart ways to hedge a portfolio, right? So, Kane, you want to get into that? I'll let you share your screen, and we can go over some tactics for doing that folks can use.
Yeah, let's do it. So first, we got to know what we're trading, right? We got to know what the premise of our portfolio is, and this is something that people just kind of ignore. So I want to start with that real fast. So I don't know what most of you guys, what your portfolios look like, but my suspicion, and you guys can tell me if I'm wrong or right, is that you get a whole bunch of signals. You get them from me, you get them from Jack, you get them from Alex, you get them from whoever you get them from, and you just take the signals. And if you do that, what happens is, let me grab something I can write with. Okay, so if you do that, and Kane says, go long SMR, and then Alex goes, hey, go long Unity, and then Jack goes, hey, let's go long Hood. Before you know it, you're in a whole bunch of long positions, right? And that puts your portfolio really one-sided, and it exposes you in case something goes the other way. So hedging is especially important if this is what you're doing. If you're a little more proactive and you manage your own position, say, hey, well, Kane said go long SMR, Alex said go long Unity, and Jack said go long Hood, and then at the same time, I find something that is doing really well on a downtrend, which I guess I should have found one at a time, but we could, let me see if I can find something really, really quick. If I, so look at CPB, Campbell's, huge downtrend right there. Okay, so if you said, okay, well, Jack said go long Hood, it had a very similar looking chart as CPB, except flipped around. And so I personally decide that Jack says go long Hood, and then I add on a short on CPB. Right? And they sort of balance each other out. This is what we start calling it, either we're beta neutral or delta neutral, depending on if you're using the stocks or the options.
And so, Campbell's because it's a low beta stock. Is that why you're doing CPB?
Because it has a similar trend going on with it. So if I was going to beta weight it, then I would need higher number of shares of Campbell's to balance out Hood because of that difference in beta. So basically, if Campbell's goes up $1, then I'll lose $1. But at the same time, Hood might go up like $5. So if I wanted to balance those out, then I would probably need 5 CPBs and 1 Hood. And the idea is when I'm right about both of them, then I make money on both ends. But if there's a market moving event that, like COVID, everything crashes at the same time, my CPB is going to make money at the same rate or similar rate as Hood is losing money. And so I have that hedge in place. And if I'm wrong about one and right about the other, okay, then I'm kind of okay. I'm just making baby progress or baby losses. So this is what we would call a long short portfolio. And everyone who is following signals, unless you're just purely neutral, you're only doing income plays, and you're only doing income plays where they're both, it's non-directional income play. So if you're buying a vertical, you're still directional, and you have a hedge to the opposite direction, and you have some wiggle room to the opposite direction. So, but you're still directional. So you would go a vertical, bullish vertical and a bearish vertical if you wanted to balance that out. Because what people don't realize is almost by default, almost every single retail trader is building a long short portfolio, except they're really, really weighted in one direction or the other. Like I said, if you just follow our signals, and then you just be really, really long in the markets right now. So if you have a pullback, you have a correction, you have a COVID event, and then your portfolio gets screwed. unless you happen to have a really small allocation. But you probably don't if you're trading anything sub $1 million. You probably don't have small allocations. You probably have, by nature of your small portfolio, you probably have pretty concentrated allocations. So if you don't want to pick your own pairs in order to have a balanced long short portfolio, or the portfolio theory is too complicated, like I don't want to deal with betas, I don't want to deal with deltas, I don't want to figure out where my portfolio is, then your next best option is a portfolio hedge. So I know I'm long all of this, and basically what it says is if my portfolio is leaning in a certain direction, then I need to hedge it in case everything goes in the opposite direction. And my favorite way to hedge if I'm going to hedge my portfolio is also utilizing what is called a tail risk trade. Okay. So tail risk trade is basically a very low priced way of playing a big move. So it's kind of similar to what Jack and Alex were just talking about on those puts. Like, hey, if I have high IV, then I can get paid a lot for a large movement. So it's kind of the flip side of the coin. So because now we're talking about hedging and not making money. So we're saying if there's a large move, I want to be able to get paid for that large move if it goes against me, or if it my hedge makes money if I'm wrong about my portfolio. Okay. So if my portfolio goes against me, then I want my hedge to make a whole bunch of money to make up for those losses. But I'm not expecting to be wrong. If I was expecting to be wrong, I wouldn't. Then I've created my portfolio completely the wrong way. So
But
I'm
you're not going to
expecting
be
to be
right every time or with
right.
everything. That's why this is important.
Yeah. So in the instance that my portfolio performs as I expect or in the direction that I expect, I want it to cost me very little. But if it goes really against me, then I want it to really protect me. So tail risk trades are ideal for that because it costs you very little, but if it works out, it makes a whole bunch of money. So
okay, I got to ask you a quick question here, if you
yep.
don't mind. When you're looking to hedge a portfolio where you got 3 stocks like that, would you look for one individual stock to short, or would you maybe take advantage of an ETF that's leveraged to the downside?
That's a great question. So if I'm looking for a tail risk type of trade, then the answer is a leveraged ETF would probably work a lot better. It's a lot easier to find that tail risk trade. And one of them, it's not an ETF, but it's along the same vein, is actually VIX, right? So VIX, because what happens with VIX, it's not because it's leveraged, but it's because when something moves, when the market moves, VIX spikes. It spikes like this. It spikes like this. Yesterday we had a baby spike just off of that.
I'm looking at that right now. Yeah, look at that.
Yeah.
That was a big one.
Yeah. So if we take it into an intraday context, yeah, that was a big spike. So we like those things because that was intraday a 2.5 point move on the VIX. So if I go and I look at, just say we had a 2.5 point move today on VIX, and just say, I don't know if something's going to happen today or tomorrow or next week or a month. So even if I go, say, a month out and I say, okay, well, what if I had bought in just at the money? If I bought at 16 right here, or just say today it's 17, okay? If I bought this and I'm paying, just say $3 for it, what happens if next week, let's just say, next Friday, we spike up three points, just like we saw, which is not even that much. Well, this thing gets priced theoretically around 250. Okay, so what's 250 on $3? It's what is that? 5 out of 6. So that's 88%, right? Just from that spiked up move. And so that's what I mean by that. You get outsized return on a relatively low cost. Worst case scenario, a month from now, I lose my $300 because we never got that spike in VIX. But if I'm making money on my 3 positions over here, I lost it, then that is more than made up for. So relative to the cost of VIX, hopefully I'm making a lot more money on that hood, that Unity and SMR. So VIX is a great way of really getting a tail risk hedge into place.
That's really cool. And you were doing 13 August, which is the next monthly expiration.
Right. So VIX has Wednesday expirations instead of Friday expirations.
Yeah, yeah. We didn't talk about that yesterday, but yesterday was this month's expiration, right?
Yeah, it was. So, and then we happen to have that.
Yeah, was that related news at all?
Well, you do see a little bit of volatility normally, but yesterday was the news. It was news driven.
Yeah. Okay. Now you trade VIX rather than VXX.
I like directly going to the index. Yeah, VXX. So because there's inefficiencies whenever you're going to an ETF, and I need my hedge to perform. I can't rely, oh, this manager maybe sort of did his job correctly, and then because if the VIX moves and the VXX happens not to, because there was like the Barclays one, I forgot what was it, UVX, something like that, and the Barclays one just completely blew up a few years ago because they didn't manage it well. So I don't want that. I don't want to add the management risk onto my hedge. I want to go directly
into the volatility this way.
Yeah.
We have a good question from RMW, on what delta is a good hedge, for a month out. And it looks like you kind of want to be pretty high delta because you kind of want that, if that spike happens, you do want to get paid for it.
Right. And also you don't want to pay too much for your hedge, right? So you remember that your expectation is that you're going to lose money on your hedge, right? This is not a trade. So you don't go into it thinking, hey, I'm going to make money on this. You go into it thinking that this money is going away. It's disappearing out of my portfolio, but I have it there because it gives me security.
You're buying in stretch, right?
Yeah, exactly.
Reid said it the same time I did it.
Yeah. I mean, and so like if you're looking at what you were the 13 August, 17 strike on VIX. I mean, right now we're at 1687. So, I mean, in a month, I could see that, VIX potentially. I mean, that doesn't seem too far away, honestly, if you just look at the past months, like price movement, on the daily.
And we got Greg saying that VIX has wide bid ask a month out. Yeah, it has wide bid ask, but remember, you're not trading this thing, right? I'm not here to get in and out. I'm not going to say, hey, I'm going to dump my hedge at any point behind this. So I'm literally just buying something and holding it and I'm hoping that it's going to expire worthless, because that means my portfolio is doing well and my portfolio is going to make money. So I care a lot less that the bid ask spread is wide. It's just, am I happy with paying $3 or whatever I get this at? Right? So, and does that make sense in the context of my portfolio? Am I spending $300 to protect 10,000? That's probably a pretty good deal. If I'm spending $300 to protect $300, it's a terrible deal. So then I'm not going to do this hedge, right?
So it depends on your like trade portfolio makeup, right? Which is RMW is actually asking that, like, what percentage of the investment will you put into the hedge? And that's an important part, I feel like.
Right. So that is, it gets a little bit more complicated, because you'd say, well, what am I protecting against? So when you buy insurance, you always have to know what you're protecting against. I'm protecting against a fire. I'm protecting against a car crash. I'm protecting against an earthquake. What is it that I'm protecting against? So if you're doing VIX, basically you're doing broad market protection, and you're saying I'm protecting against a downward movement in the SPY. And so you ask yourself, well, where do I want to be protected? Do I want to be protected exactly where it is right now? Do I want to be protected if it drops below the MA50 or below the MA200? Because then we'll really be in a bear market. So where do I want my protection? And is my portfolio okay? So if I say, hey, I'm expecting a 3 to 5% pullback and I'm 100% okay with that, I position my portfolio perfectly for that. But what if we get a 10%? What if we get a 20%? Then I need my market hedge or my portfolio hedge in place for that, because my portfolio is going to be just fine. The volatility, the drawdown is going to be very mild if I get that 5% pullback. But if I get a 10% pullback, that represents a big hit to my portfolio, and I want to hedge that. So go ahead.
Go ahead. So for people who are like looking at that and they're like, okay, well, I do, because we've been talking about this. We were talking about this with Chris the other day. He was expecting a 3 to 5% pullback. How would they determine the price of VIX to buy? Is it that rule of 16? Is that what it is to determine the price on the VIX strike for the price pullback that they're trying to hedge against? Does that make sense?
Yeah. Okay. So that goes into what you expect your portfolio, what kind of hit your portfolio is going to take. Or if you just want to look directly at VIX, then what you would do is like, okay, this was a 4-ish% pullback right here. Where does VIX go? Right there. So from May 16th to May 30th. Is that right? That sounds too long. May 19th to May 23rd. Okay. Yeah. So I'll go to VIX and say, where did VIX go May 19th to 23rd? It spiked all the way up to 26. So 26 VIX would be normal-ish. So 20 to 25 would probably be normal. And then so I would hedge against VIX spiking beyond that if I was okay with a 5% drawdown. If I'm not okay with a 5% drawdown in the S&P 500, then I'll go maybe 20. 20 is a different volatility regime than what we've been in. We've been 15 to 20 right here. So if I spike above 20, then I want to be protected against that. Okay, so then I'll start looking closer to 20 on my VIX. So I could go out to 20. That becomes a lot cheaper. And then if VIX spikes up to 20, I guess before expiration, I'll still make a little money over here. But if it really spikes, if it goes to 25 or 30, then I have a lot of protection. That's where this is really going to start making money very quickly. So that's how I would go about choosing my strike on VIX. If I'm saying, hey, I want to be hedged right now, this moment, I don't care if it drops 0.5% or 1%, then that's when you would go at the money.
Yeah, and this is a great time to do that hedge with the market the way it is right now. Constantly, people are asking, "What can I do to protect myself here?" Right? With the market being high, it's almost everybody's waiting for a little bit of a pullback. And as we get closer to August, you can expect a little bit of a pullback. So your timing on this and your explanation of this, Kane, is fantastic.
Yeah, this is really good. Yeah. Well, we'll record. I know we're gonna get that wheel video to folks. We're gonna get this one to folks, and this is a little more complex probably. So I want to make sure you can review it. But anybody have any questions about this? Let us know in the chat if you have any specific questions or just clarification you want on anything that's Kane saying.
The other thing that I'm always cognizant of is major options expiration dates, which we happen to have one tomorrow. So tomorrow is the monthly expiration for July. So what we could see is a lot of rebalancing and repositioning inside the options market come Monday. And so if we do have a pullback, it could get triggered next week. simply because of that options rollover.
Yeah, those OPEX dates are important to pay attention to. So like probably looking to close some of my positions, even though I probably technically on the chart, like I have some more room to run, but might as well just close them out. not over the weekend and see how it pans out on Monday, right?
Yeah.
Yeah, really good stuff. The exit for Hood if we go long, that's up to you. I think we're all, I don't know about Kane. Kane, are you bullish on Hood? I know Jack, I'm bullish on Hood. Just I don't really.
I don't know how you could go against it until it
Yeah.
breaks, right? You got to go with what you see.
Same with Nvidia. Those are two stocks. It's like, how do you go against either of those companies until they
So
break, right?
I've seen so many people get killed. People I know got killed shorting Nvidia, right?
Yep.
Even this last time, it dropped down to like $80 on Liberation Day or something, and people were pounding the short on that there, thinking it'd go to 40. It got killed. So one thing I don't do is I will hedge, but I don't short stocks when all three indices, QQQ, SPY, and DIA, are above all three trend points that I use. If the market's bullish, basically, I won't short any stock.
Yeah.
But I will hedge everything. But just like when the market's bearish, I really don't go long anything. I just trade in the same direction as the broad market, right? You use a market-driven strategy, so you're always trading in the same direction as the market. So I don't short any individual stocks in a bull market, but I do hedge everything.
Yeah, everything's got to be done in context, right?
Yeah,
The
the higher the
wider
market
context of the
goes,
stock is the
yeah,
market.
the
Yeah.
higher the market goes, the more you got to look at hedging it because it's not going to go up straight up like this, right? We're going to have pullbacks, and it's healthy to have little corrections along the way. So you got it. You almost have to be hedged right now with the way the S&P is high,
Yeah. Very, very high.
very timely.
And I, every day I just kind of use a daily screener, just like just trending tickers. Like, I if you're not Michael Burry, right? You're not going to figure out the next great short opportunity. Just go with what's leading the market, right? What's leading the market? This is a little scanner I have on TradingView. Every day I just look at what's leading the market, right? I find, uh, look, okay, so what's leading? What's high volume? And then you just go with the trend. You wait for the, price consolidation, a little bit of resistance forming, tightening price band, and you just set your levels. And when they break out, you go for it, right? But yeah, that's the same what Jack's saying. Like, don't try and figure out, oh, market's going up, but I'm gonna go the opposite direction because I'm so smart. I don't pretend to be that smart. Let's see. Francis is asking, could you please go over the strike to choose to hedge with VIX if there's a chance? Francis, he did just do that. I don't know if did you catch that, Francis, or are you just logging in now? Let us know. He'll briefly go over it again if you just logged in, but we're also going to record this and shoot it out to everyone. Kathy didn't catch it. Yeah, so basically, it's basically figuring out. You look at the time SPY corrected, right? So, here was like what, a 4% correction, and then you'd go over to VIX and you would look, okay, on May 20th, right? May 20th, how much did VIX rise? And it was up to 20, 24, 25. So you would use that. Basically, you would go out either 20, or if you're, more okay with that 5% correction. If you only wanted a 3% correction on your portfolio, you would go 20. If you were okay with the larger drop, you'd go out farther, 25. Am I saying that right, Kane?
Yeah, that's spot on.
Okay, cool. Yeah. So Francis, that's like just a little, Kathy, Francis, that's just a little recap of it. Don't worry, we're going to record this. We're going to get it out to all of our profit panel members. So be sure to sign up for the Telegram, and they'll drop the links there because that's the way we'll be able to send it out to folks. We'll post it in the Telegram for me, Jack, and Kane, and the rest of the guys as well. Once we get the server set up for that to host it, all these videos and whatnot. Size, I don't know, Kane, if you have anything to say about size. You kind of touched on it briefly.
Yeah, it also depends on how much you want to hedge, right? Do you want to hedge away all your losses? That's going to become more expensive for you. Or hey, I don't want my portfolio to go down more than 5%. Okay, so then you calculate that. So you would need to say, hey, if VIX goes up to 26 and I have the 20 strike, right? That's a $6 move on a 1 delta. But if I'm buying out the money, just say I'm buying the 40 or 50 delta just to make it easy, that's a $3 move. And if I paid $1.50 for it, then I just made 200%. So if I'm hedging I'm okay with a 5% drawdown, but not beyond that, then I take that dollar amount loss of my portfolio. Then I say, okay, how much money do I need to make a 200% gain in order to make that money? And then that's how many contracts you would buy. Right? But if you're trying to do a perfect hedge where you're not going to lose any money, you're going to pay a lot for it. So you have to take some risk in the markets. So you have to be okay with at least some drawdown. That's the point of a hedge, not to make money or to completely erase losses, just to make the losses acceptable for your portfolio.
Yeah. So yeah, David's loving this. Maggie, we'll get Jack's Telegram dropped in there. iPhone's asking, can you do this with the NASDAQ and other indices like so QQQ? Yeah, I mean, it's the same thing, right? If you have a position in QQQ and you do the same thing that we showed, right? It's just determining what percentage you're okay with, and then looking cross-referencing that with VIX and determining how much did VIX jump. It probably is going to be the same, really. I mean, they're similar, at least. But then you cross-reference that and determine that your personal tolerance for what you want. Really, really cool stuff. This is really good. We'll get this out to everyone. Kane and Jack, I know I think both of you guys gotta head out, so I'll just get into my segment. So we had thank you both. And feel free to stick around as much as you want, but if you do want to, whenever you gotta head out, feel free. So we had a really big trade yesterday. Today we closed it out. It was about 120% winner on ASTS. Which is another one of those high premium stocks, actually, that shows up on that premium scanner a lot. So let's go ahead, and I'm just going to share my screen here. All right. So first off, I want to go over, so this is basically swing trading options, right? So this is more aggressive, right? This is you're betting on price, and you're going with just a call or a put. Now there's three things that I look for. Like I said, I use that scanner on TradingView every day. I just look for trending tickers that are going up. And then I narrow that list down. I just go through them all. I look for, just a bird's eye setups on them that could be potential add them to the watch list, and I dive deeper. So I'm looking for a tight pattern. All right. Descending volume during a consolidation phase. And then it's above moving averages. Okay. So let's go to this ASTS trade that I'm going to show you. Ooh, ASTS. All right. So we were watching this baby, and what you see here, okay, so you have all the parts forming. Now, we had all-time highs, a little consolidation phase, a little, flag pattern here. And oh, Pete, yeah. Pete, did you get in on that winner? Let me know what you made, or what percentage or money or whatever. I'd love to hear it. So, but we had this. Look, so what happened? We hit all-time highs, and you can see this clear rejection of those all-time highs, and then a sell-off down here, right? Starting back on June 27th. So sold off, right? Descending volume. We had descending volume into this consolidation period. And we had a bounce, right? It tightened up, and then we had a bounce off of the 20 here. Now it started moving up. Now you could have entered here, but I wouldn't say this is a super, super high conviction trade if you do enter here, because it could have easily reversed on us, right? This trade. What I was looking for is if you kind of zoom in here, you can see that at this level, right, we had a little, not back here, this was a good resistance level that was forming, right? Price bounced over it multiple times. And after it started to recover, you even saw on the day of July 14th, right? So this was Monday, it bounced off again on this resistance line. So I was watching this, and when it did this, right, I said, okay, if it breaks above this resistance line, we're going to go long. Okay. And it did. All right. ASTS did break over. And again, we actually didn't even get in on this trade to that day. We got in yesterday, and we made, I think I got, depending on your fill, Jim made 50% overnight on it. Awesome. Awesome, Jim. Pete, let me know what you did, man. I want to hear from you. Anybody else who was in on this trade as well. I got in at, let me see exactly what I got in on ASTS. So yeah, yesterday, 243 and sold for 515. So I got in at 243 for that 53 call and sold at 515. So that's over 100. That's maybe 100. I think it was 120%, right? And that's really just the every day, right? You can just go through every day and run those scans, find the tight consolidation patterns. And I'll show you what these consolidation patterns look like. Like let's look on Toast, right? So this is the exact same thing that happened. Look, we have this, you have to go kind of back for this, right? So back on we had a big run up on Toast. But then you bounced off of this resistance level, and you kind of had this consolidation pattern forming, consolidation pattern into descending volume. So if you look over here, you see the descending volume. See how it's descending through this consolidation pattern? And I'm not going to enter this trade when it's not above the moving averages, right? But then it started recovering above the moving averages, and we started banking up against that resistance line. Pete made 125%. Awesome, man. That is so sick to hear. Now, look, this is an example of a trade I didn't take, but I could still take it. Jay got 99% profit. Heck yeah, man. Pups is asking the profit panel Telegram. We actually should create a profit panel Telegram. That's actually a great idea. We should just create one that we can drop all this info into. We don't have one. I think we're going to create that though. I'll let everyone know, in the next coming days when that's right and set up. Now, look, this is still a potential good trade, right? So Toast gapped up today, and that's why I didn't trade it, because I'm not going to trade a gap up and then look what it starts selling off. But this support line, this is actually still pretty good. This is going to be a support line now. So what we want to wait for, right, is it just to trend down to the support line, see if we get a bounce, and then look to go higher. But this is the exact same strategy. Again, descending volume into a consolidation pattern above the moving averages, and then breaking over a resistance line. And and then the question is, right, so let me see where my Joby position is. We did the exact same thing, free trade on Telegram today. Joby, I'm up 19% right now. So it's exact same thing on Joby. Let's see what happened with Joby. Again, so this one was interesting. Higher volume breakout yesterday, right? And again, descending into, I mean, really, I was late on this trade, right? We could have gone here and just run it up, but we didn't. We missed it, but we did have this resistance line here that formed. And then what was interesting, the way I established this resistance line is we went back all the way to their basically IPO highs, which is back here. So again, when a stock is in a trending market like this, when these types of tickers are hitting, reaching up against all-time highs again, you just wait for that breakout to happen. And that's what happened here. Now, what's interesting is actually when we opened this position, I felt bad because it basically immediately, not immediately, we got a little bit of a pop and then it starts selling off again. But I turn over to the 5-minute chart and then I just watch. If it rejects the breakout candle here on the 5-minute chart, I'll usually get out. So if we had dropped below this resistance line, this support line at 1653, I would have exited. And but we didn't. Ooh, Maggie sold a put on ASTS. Heck yeah, Maggie. Took 140%. That is awesome. Jeffrey will love to hear that. We'll forward this over to Jeffrey. But because this did not really breach this candlestick, this breakout candlestick, we stayed in it and now we're up. Okay, so that's what's really cool. You do the daily, you can do the weekly, right? And then you can just and when you enter, use the 5-minute chart just to determine your entry and make sure that you're entering at a good momentum breakthrough. I want to go back to the ASTS trade because there was something else that showed up on ASTS that really made this trade a no-brainer for me. And this is on the daily chart. So check this out, right? So I got all this criteria done, right? And you can use, I got all my criteria set. But what was really interesting is not only did we have a breakout over that resistance line, but my wave indicator printed out a call on the exact same day. So I was super convinced that this trade was going to work out. Now, what is that indicator, right? That's the question. What is that indicator? Why can it be used to find and corroborate your trade theses like this? So I built this thing myself, and it's really cool. I really like it.